Well, welcome everyone. We're at week 9 and we're going to be covering the final chapter in the textbook, chapter 11, which is on allocating costs of managing risk. And then next week we will be doing the final review and we'll be covering all the different chapters. Even though this is a fairly short chapter, we'll probably be spending a little bit of time on the slides or on the charts at the very end to talk a little about the different ways you can do claim cost allocation. As I always talk about when as far as the importance of different chapters, what I would probably say is that allocating costs is one of those things that's probably misunderstood or not done very often or to the degree that it could. In many cases, most of the time when people allocate costs, they'll just do it at the very beginning, but they really don't do it, to do like a retro and so do what I guess you'd say feel the pain of really what the insurance costs are. In most organizations, you'll hear me talk about socialized, and what that means is that essentially we're spreading the cost or the pain among everyone when we have a socialized system, rather than doing one that's specific to a department. And it kind of breeds accountability, and I think that's what you probably read in this chapter is about how a claim cost allocation system can do that. So as far as the objectives that we're going to be covering for tonight, the first one, describe the purpose of allocating hazard risk management costs. So when we talk about hazard risk management costs, we're really talking about those things that are involved with the insurance coverage aspect of it. Describe the types of hazard risk management costs an organization may want to allocate. Describe the prospective and retrospective approaches to allocating hazard costs. Describe the exposure bases and experience bases used to allocate hazard risk management costs. And then finally, some practical considerations when selecting some of the risk management cost allocation basis. And then finally, given a case study, justify how hazard risk management costs may be allocated among the organization's departments. And I think that's the last piece that we're going to go over is that you'll see is there's not one way to do claim cost allocation. There's many different ways, and you have to pick one that's going to work with your organization and that will really encourage, as we talk about some of the purposes of risk control and some of those other types of techniques that go with that. So going on to the very first aspect of it is, what's the purpose of allocating hazard risk management cost? And the kind of the 4 areas that you're going to focus on, and again, from a test question, most likely this would be one of those. Cost allocation systems should focus on the following risk management costs: retained losses, insurance premiums, risk control costs, and administrative expenses. And we'll go into a little more detail about each one of these. Now, someone brought up earlier that when they were reading through this, when you talk about cost allocation system, is that a computer system? Well, really, it's a methodology is really what we're talking about when we talk about a cost allocation system. And so retained losses, as we've gone through this, well, retained losses is anything that we're paying, that we're self-insuring, or if we're in a high deductible, those are the costs or losses that we're paying for out of pocket. Our insurance premiums, that should be self-explanatory. Risk control costs, those are the costs of staff, of those that are handling the claims. The prevention efforts, risk control costs can also be equipment that can be purchased to help reduce some of the risk control or some of the losses. And then finally, administrative expenses, which are typically more of handling the administration of a claim, the legal aspects of hiring attorneys and things like that. So those are really the 4 main areas of risk management costs that you can allocate within a system. And so one of the things that they put in here is that the sentence in here is effective risk management programs require that most costs be allocated to the department that generate them, and that's really as much as an organization can charge that specific department, or if you're a university, that specific campus, and if you're at the campus level, then can you go, how far down can you get the costs allocated? The further down you go, the more accountability that you're going to be able to bring. People take responsibility, and hopefully you'll see some of how that might work. Now, I'll be mentioning Raley's quite a bit, which is a employer from about 10 years ago. Raley's Supermarkets at the time had about 150 grocery stores, and they actually had a fairly sophisticated claim cost allocation system, and so you'll hear me talk about that quite a bit as we go through the program tonight. So some of the main cost allocation principles, and some of the effective program should serve the following purposes, and again, this is something that I would probably highlight, the area that you want to focus on. An effective program is going to help with promoting risk control. And we're going to go through each one of these in a little more detail. Facilitate risk retention. When we talk about facilitating risk retention, that means the idea that if we do it right, we're going to actually keep on retaining more risk, that because our program's effective, we're actually going to continue. Maybe we start with a 10,000 retention and we go up to 25,000 or 50,000. It's going to help encourage, facilitate risk retention is what that means by there. Prioritize risk management expenditures. And again, we'll go in detail on these, but the idea behind this is that if you know that certain types of injuries or claims are driving your costs, well, you probably want to focus your expenditures on those things that are driving the costs rather than just do what I consider a shotgun approach and just say, okay, hopefully we'll do the right thing by implementing this one program. If you do all these things, if you kind of, all these prior, three things, ultimately it's also going to reduce your costs, both from reduction in actual losses and as well as insurance premium. The other principles that it'll hopefully do is it'll distribute costs fairly. That probably one of the biggest gripe for university setting, if you want to consider this, is why, if I'm in the English department and we don't have any losses, why am I paying so much for my insurance? Why is my department getting charged so much for workers' comp costs or things like that? And that's a challenge because it's, it should be based upon the exposure. One of the things that you'll find with the workers' comp insurance rating bureaus, they have class codes. And one of the ways that you can distribute costs more fairly is the idea that you're going to charge more to insurance to insure roof, a company that does roofing, than you are that maybe one that just does clerical support. So that kind of goes into that whole idea of how do you distribute costs fairly. Balance risk bearing and risk sharing. Again, risk bearing is meaning charging really the departments or those that are doing it, and risk sharing is more of the socialized aspect that I mentioned earlier. And then finally, provide managers with risk management cost information. For those that work in the insurance area or work with loss runs, what typically happens is maybe you, as a manager, you might provide information to management or to managers that are managing line staff, and they might get a little information on the claim, and they might see initial cost of maybe $10,000 for an injury. What they don't realize is that claim required back surgery and these other things, and now it's a $350,000 claim. And typically, most managers never see the ultimate cost. And if a cost allocation system is done appropriately and it's effective, then it will also provide managers with the cost information. It'll make them realize, which will make them, facilitate risk retention and promote risk control when they see how bad some of these claims can actually be. So here's kind of going more into the detail of some of these different principles. And so the first principle that we'll talk a little bit more about is the promote risk control. And the primary purpose of a cost allocation is to promote risk control and by allocating cost of loss or potential losses to the responsible department. And the idea being that each department is going to be held accountable or rewarded for the risk control efforts. So if I know that as a department head of an organization, whether it be manufacturing or a service industry, that if I'm going to be charged for an injury and it's going to affect my bottom line, then I'm going to pay attention to that. For Raley's, for example, we'll kind of use this as the example throughout, is that because Raley's was self-insured, they're on the P&L statement, they had a line for workers' comp. And within there, what would typically happen is they would have a certain, kind of the prescriptive model is that they would allocate a certain amount of expected insurance or workers' comp costs. But at a certain point, if they exceeded that amount, it basically affected the bottom line or the profitability of that individual store. And so it was not uncommon that the difference between a store being profitable or not was the number of injuries that were occurring and the cost of those. The other piece of the promoting risk control is that it also really pushes the focus on frequency. Many times people have heard the term, frequency breeds severity. If you don't have a claim or any frequency, then you're not going to have any costs or severity associated with those claims. And so it's also going to help focus on the frequency of those by just preventing the injuries or claims from occurring in the first place. On the next item, facilitate risk retention. So a program needs to be balanced so departments are not exposed to excessive fluctuations in cost and are encouraged to increase risk retention. So as I mentioned, that you want to have a program that is, that encourages, the focus on frequency and allows for like maybe a staggering of encouraging more risk retention. The problem is that if you start a program and you say we were going to have a $100,000 cap, that each claim is going to be charged up to $100,000. The problem is you're going to see if you're going to have claims, there's a lot of ups and downs. It's not going to be smoothed out if you look at a line chart. So the example I give with Raley's is they had a claim cost allocation that was, when I left, was 3 years or $50,000 per claim. What that means is that each individual claim, in this case workers' comp, actually this was also for general liability claims, each claim that was presented or reported, that individual claim would either be charged to the bottom line of the P&L to that store for 3 years or up to $50,000. After $50,000, it was capped. So we called it a claim cost allocation or capped claim allocation program. So that way, the worst pain they could feel would be $50,000 per claim. And so it's very similar to a self-insured retention that an organization might take on, but you're really reducing that self-insured retention almost down to the unit level. And you've got to make it a little more manageable. Now, I say that when I left, they ended with 3 years, but the program really started at 2 years and $10,000 and was expanded over a period of time, and it went up to $25,000 cap. So and I know some locations that they start off with, they're going to do claim cost allocation of 1 year up to $1,000. And what that does, it creates a deductible program is essentially what you're doing, and you're facilitating that risk retention. And slowly you might go up to $5,000 and then up to $10,000. But the idea is you're going to smooth out some of those fluctuations by doing a program like that. You're also going to be able to prioritize risk management expenditures. So, if you know where your costs are coming from, and you know that if I'm a manager and I know that I'm going to be charged if I have a whole bunch of slip and falls, whereas before if it's socialized and they go, oh, it's just the cost of doing business. But if I know these slip and falls are really affecting my bottom line, I'm going to pay a lot more attention to it. And then I want to try to solve that problem because, my bonus might be predicated on that or the store's profitability. And so it's going to encourage those managers to really focus, dollars of what they're going to spend to reduce those types of claims. So they'll focus risks that are driving claims which will have the best ROI. Now, for those in the University of California system, we have something called Be Smart About Safety. And it's really based upon the same principle, the idea that if we can identify those areas that are cost drivers, from not just a compliance issue, but how can we reduce injuries or claims, buying equipment or those type of things, now we're actually going to see a lower cost, which ultimately affects the amount of cost or the insurance program cost or the total cost of risks. It's reducing that, which really goes down to the next item, which is, obviously we want to reduce costs. And so as risks are better managed, which means we're having less claims, and that's what Be Smart also did, it allows the organization to retain more risk, thereby reducing cost. So the idea being that as an organization, maybe we're fully insured at one point, and then we go to a $10,000 deductible, and then a $50 and $100, and ultimately, just like the UC system, where we have a $5 million SIR, at some point we can continue to try to reduce our risk or retain more risk because our programs are being effective. And then also the idea is that our total cost of risk is also going to be reduced over time. So the T-Corp that they mentioned in there that means the premiums that we're paying for excess insurance or reinsurance all those things are going to be reduced over time because we're having less claims, because we're really doing an allocation system. And the whole idea, if nothing else you get from that allocation, is you're really trying to bring accountability to the managers. And people pay attention when it's dollars and cents more than anything. So the next item, or a core principle, is needs to be able to distribute costs fairly. And so I kind of put the example, should administrative departments pay claims that occur in maintenance departments? So a lot of times what you'll find, I use in the university setting, English department. Well, they're paying workers' comp coverage, or they're contributing to the work comp program a certain amount based upon their payroll. And it's possible that they've never had a claim in 10 years. Well, that money's paying for something, and usually it's paying for claims most likely in a facilities or maintenance department where those claims are actually occurring. And so the idea should be, well, should we charge a different rate? Or let's use police and administrative. Typically in most cities, there's a couple pools that are out there. One is called LOCS, which is a excess workers' comp program. It's a statewide, what they call a kind of a super pool, and they basically insure other large cities for excess insurance. One of the things that they've broken down is they have a category for charging rates, which is police, if they have peace officers, so they have a rate specifically for those that are in law enforcement, and then everyone else, with the idea that those are in law enforcement, you're going to have a higher cost. And so instead of just paying a socialized and blending the rates all together, they try to separate them out. Now, for some organizations, such as a large university, we probably have 1,000 class codes. And so it would probably be pretty difficult to separate those out. But we could, and when we talk about distributing costs fairly, we could say, okay, administrative and academic functions, we're going to say we're going to charge this rate. For maintenance, it's going to be this, and police and fire, it's going to be this rate. So you could do buckets in which you would, distribute the costs fairly by doing that. And the idea on the second bullet there should be a direct correlation between losses and the risk management costs that are allocated. So we typically know that those departments have higher costs, and also the idea is that if they are being charged more, it also gives them more incentive to hopefully correct the condition, that accountability, their bottom line. Now, one of the things I keep on talking about is bottom line. Now, for public entities, which many people that are part of the class that listen to this are part of that, there is not that bottom line incentive, but there is the incentive to reduce costs and efficiencies. And that's really what we're looking at, is that can you provide some incentives for those departments to reduce their injuries, and that's what we're trying to do. And there might be some other means that, hey, at least for us, if you take a look at the money that is not being charged because we've reduced our costs, that's more money that they can spend on providing raises and other types of things for their employees. Then the other item on here is provide managers with risk management cost information. And on that one, I kind of reversed the order on this, and the reason why is that, again, most managers, they don't get the information, and the more information they have, you don't necessarily have to provide names or those type of things because we don't want retribution. But what we do want, that we want them to be concerned about the bottom line cost, and if the more information they have and they realize that there is a true cost to the organization every time an employee is injured, or where there's someone slips and falls and a visitor or a patient has a claim, they're more likely to manage those things, and you can measure that. And so, as part of the effective system, some of the principles are make sure you provide managers with that type of claims information, and it should reflect whether it's the system you set up, whether it be the 3-year 50,000, 2-year 25, or whatever. That's the type of thing that's going to interest them, is what really affects them. Now, the second bullet on there, on need to ensure the system cannot be manipulated or injury hiding. One of the challenges that any organization has is when they do a claim cost allocation, where they know it's going to affect the bottom line, or if there's bonuses predicated on injury rates or things like that, is that there's the potential for a manager to tell employees, oh, you don't need to file that claim. Here, go see your own doctor. I'll pay you $100 and just go see your own doctor. And there have been cases, there's actually lots of cases where that's happened. There's also the concern of who has access to the data. Can they manipulate the data, after the fact as well? One of the challenges that I will say that typically happen, at least one, Rayleigh's had bonused on injury rates as well, is that at the end of the year, you have your 12 months, and at some point, then you start a new reporting period because you're in the new year. Then all of a sudden, what you see is a whole influx of injuries in the very first month that were kind of being held over. So that's something that that was seen when we talk about manipulation. It's kind of holding on to that claim. Let's just wait till the next reporting period so it doesn't affect my cost for this current period. And so, just like with people, when you look at the IRS and doing their taxes, people try to, make sure pay the least amount as possible, and it's kind of looking for all those different loopholes. And I would say the same thing. People are going to, if you want to call it game the system, that's the concern. So you got to make sure that the allocation system is set up in such a way that it's also being seen as fair, and it would be difficult to manipulate as well. So moving on to the next main topic here, which is on risk bearing and risk sharing. So the challenge that everyone has on here is when we talk about risk bearing, it's a cost allocation system that allocates losses to the individual department that generates them. And that's usually seen as talked about as being the most effective way. And the organizations that focus on risk control focus on risk bearing systems. So the more risk bearing that you're going to go towards, if it's an 80% threshold that you want to have, or 80% of the claim costs are going to be allocated on a risk-bearing basis, meaning the department that generates them, it means typically that there's going to be more risk control focus, that there needs to be substantial resources to help prevent the claims from occurring in the first place. And that's usually going to be the focus of those type of organizations. We talk about risk-sharing system, or what a lot of times you'll hear referred to as socialized. And it's a cost allocation system that allocates losses among all of the organization's departments. And so, why would you do a risk-sharing system on a socialized and not do the risk-bearing if it makes all that sense? Well, a socialized or risk-sharing system is pretty easy. You find out what your costs are. The actuary says, here's how much you need to charge. Here's your the insurance premiums. Here's all these things that need to be included in there. And then next thing you know, you just go ahead and you just charge everyone equally, or you charge it based upon a payroll, and you're done. And so that's why you typically see risk-sharing systems, is because they're easy. They're easy to manage because once you get into risk-bearing system, that means you have to have systems in place there, and you also have to have buy-in from senior leadership, and it's something that has to be managed on a regular basis. It's with a risk sharing, you can probably set up everything up once you have what the costs are, and you send your bill out and you get your payments, and again you're done. So that's really the difference when we talk about risk bearing and risk sharing, is to understand why would one be preferred over another in this case. So when we talk about so we've talked at this point about some of the benefits, of the principles behind it, what types, whether you're going to do risk sharing or bearing. Now we're going to talk a little bit more about, what are the costs that you can actually be able to do. So we do have a question: is risk sharing in equal proportion while sharing is in individual proportions? So if I make sure I understand the question correctly, so is risk sharing in equal proportion while sharing is an individual?
I think that second sharing.
I think the sharing might be bearing. Okay, so the idea, it doesn't have to be, so when we talk about risk sharing or you can actually have blended systems, and that's one thing I probably should have included on there, is that typically you'll find a lot of systems they'll do 80% socialized and 20%, 80% risk bearing, and then 20% socialized. And there's a couple of reasons for doing that, and the idea is that when we talk about the claim cost allocation, anything above $50,000, you say, okay, you're not going to have to pay anymore. Well, everything above that 50,000 allocation I mentioned, now it's socialized because everyone else is now going to be helping pay for that claim at that specific location. So there is a little bit of socialized versus individual accountability, which I think the question is geared towards. So you can do some manipulations around it. So it's not necessarily equal 2020 2020. There can be locations because of their size, the number of employees can be differently allocated. Okay, kind of as a follow-up, is risk sharing, is everyone sharing in the pain equally while bearing is variable pain? I think that's a good way to explain it. I mean, the idea that from a risk sharing standpoint, again, from a socialized, if you think about it, is that I may not have any claims, but I'm going to share in that pain equally because it's for the greater good, if you want to put it from that standpoint. While bearing is variable pain, yeah, and that because if I don't have any claims and I get allocated, so as an example for a Raley store that had 0 claims, and we had several stores that I'm pleased to say that was in my territory that had no claims. So they were allocated, let's say, $500,000 a year was what their expected claims were going to be. If they didn't have any claims at all, that $500,000 that was put on there as a placeholder now became part of their profit. So the rewarding, when we talk about being rewarded, is that because they didn't have any claims, they were given $500,000 as part of their allocation or what they kind of paid into. Now that $500,000 got to stay there as part of their bottom line profit. So I would say it's variable pain and reward in that type of instance. So good questions. So going back to the types of costs to be allocated. There's typically the 4 costs when we talk about the costs that we can allocate. There's the cost of accidental losses that are not reimbursed by insurance or other outside sources. So the idea is, in other words, it's what you're retaining. That's the simple word. It's cost of accidental losses not reimbursed by insurance or other outside sources. And other outside sources might be if someone hit a car, you might get reimbursed by the third party, or the other insurance company might be doing that. So any of your retained losses you can allocate. Insurance premiums, okay, that's self-explanatory. If you have $100,000 insurance, you can split that among the various groups. You have the cost of your risk control techniques, okay, that can be your staff, it could be equipment, your safety professionals, ergonomists, those type of things can be allocated. So within our office, there's typically the staffing is part of the administration, and that is going to be our costs are spread out essentially through as part of the claim cost allocation, and so that portion is socialized to everyone. And then finally, there's the cost of administering risk management activities, and some of those risk management activities would also be loss expenses, or it could be. Let me see if I can, operating budgets, cost of executive time in other departments, and just other type of, just anything administering, that's more of administering what we do in our department. So our directors of workers' compensation, our professional liability, those would be the cost of administering the risk management activities. It's more the administrative overhead, whereas the techniques is really more of the boots on the ground. So they're they can be combined in some cases. So when we talk about types of costs to be allocated, there's the cost of accidental losses. And so so some people have heard the term ALAE or ULAE. And so now if you've always wondered what that meant, now you'll know. So we have allocated and unallocated loss adjustment expenses. So allocated is ALAE, is identified with a specific claim and includes investigation, negotiation, legal, and other costs associated with the claim. So if you think about ALAE, is if you have a work comp claim or a claim that's a vehicle claim, general liability, it's those costs that are specifically allocated to the management of that individual claim. Those things, so it's the doctor bills, it's the lost time payments, so the those type of things. So that's allocated, meaning specific to that individual claim. Whereas ULA or unallocated loss adjustment expenses are not identified with a particular claim. It's more the general overhead of kind of your third-party administrator, what you're going to be paying. So if you might be paying a portion, let's say, for the risk management information system, maybe that's part of the general administrative expenses or loss adjustment expenses that's going to be spread amongst all types. Or another way to think about it, it's kind of a socialized aspect of it as well. And a question came in as far as ALAE and ULA referring to costs billed by a TPA. Typically, it's more in reference to the TPA, absolutely. But if you have in-house expenses, if you have your own in-house administrator, if you're going to do those, you would also recognize ALAE and ULAE as well internally as the types of expenses that may be paid out. But typically, most commonly, I think most people are used to dealing with a TPA, that they're going to see these type of expenses as part of some of the costs on their claim files. We also have other types of allocating what's called retained losses. And when we talk about these, some of the costs here, there's different ways you can do it. There's what's called incurred loss basis. And when we talk about the costs here, it's the way you can decide of when you want to, what things do you want to charge your individual departments or units. That's really what this is talking about when we talk about allocating the retained losses. So on the incurred loss basis, it's paid in reserves for pending claims plus estimate of IBNR. So if you have your TPA, we'll just use that for workers' comp, they're going to have an idea of what the paid in reserves are for pending claims. And then, because when they do this incurred basis, it's the idea of what they've already paid out, what they think the claim's going to cost, and the IBNR is kind of like, that's the squishy factor. And the reason, so whether you want to charge an organization or a department for those specific costs is those things are going to change, or they have the potential of changing over a period of time. So that's one of the considerations with that. On the claims made basis is the idea of adding actual claims payments to changes in reserves during accounting period. So this is what I would say Raley's did, is that so over a period of time, they would say if the claim started at $10,000 and then it got, because it was claims made, or the actual claims payments made, they weren't necessarily charged for the reserves, but then it got changed again. They paid another $5,000 and then they paid another. So those departments were specifically charged for the actual cost made during each accounting period, up to the $50,000 amount. And then finally, you have the claims paid basis, which is the amount paid on losses during account period, regardless of when losses occurred. So the idea being that that a claim may be from 2 years ago, but now we're going to be paying for it. It's still going to be accounted for during that that one time period. So these are the three different types, and it'd be easier if I had a chart to probably show you how the claims paid actually work. But the idea is at what point do you want to charge a department? Do you want to charge them when you think you know what's going on based upon reserves? Do you want to do it on what you actually paid? When the claims are actually made during that time period, so during that accounting period, or do you want to do it on when they're actually paid out? So those are the kind of three concepts of when you want to charge a department. That's really what that's going towards. It looks like we may have a question. Oh, looks like it was put down there. Okay. So Herb, I'll go and open up your mic.
I'm going to try and type it here.
Herb, you're good. You're online. I can hear you. Go ahead.
Oh, what's the window for INVR claims?
Okay, so when you say window, what do you mean by window?
To pay them or to claim them.
Well, basically, I mean, the idea of an IBNR, I mean, by year 4, IBNR is pretty much gone. So the idea being that over a period, so if you do paid reserves plus pending IBNR, that may change, and because most claims by the second year, you're probably paid up to 80% of what they expect, the total cost is probably going to be. But by year 4, you probably paid 95% of the cost. So it's an estimate of IBNR, and that might be your loss development factor that's going to be charged to it. So if you say at year, you're going to say, at the end of the calendar year 2014, we have these claims for these departments, and it costs $10,000, and the loss development factor is 2.71. The estimate is that we're going to charge that department $20,000 or $27,000, whatever that is, the 2.71. So I think that's kind of what you're getting at. Is it depends. I mean, the idea behind at least the concept for the textbook is you can include that as part of it, but it's up to the organization to decide what that's going to look like. They can decide we're only going to go up to 2 years, up to 3 years, and then we're going to stop doing the calculations for it.
I was thinking more like asbestos claims and things like that.
Okay. So most likely on asbestos, you wouldn't allocate those.
Okay.
Most likely from a claim, you're going to have, on an insurance standpoint, you're probably not going to retain those type of losses because the period of which the loss, I mean, those claims can be from 30 years ago, and it kind of depends on what's going on at the time. So I would say those type of unusual or the, I don't know if they're unusual anymore, but longer term illness type claims that have a long development period, typically they're more likely to fall under the insurance program and more likely to be socialized because I would say you wouldn't want to allocate those to a specific department because most likely those costs are going to far exceed any allocation there. So that'd probably be pretty rare to do that.
Okay.
All right. Well, we need to back up. All right. And a very good question. So, and then finally, the other thing that we can allocate is also risk charges, which are amount added to an organization's expected losses to cover potential adverse fluctuations experienced. And well, I think we call that the weird factor, I think. And you see that there's always going to be those kind of weird claims or those unexpected losses. And so typically there's going to be a risk charge that's just an extra percentage that we're going to put in there, and it's going to give an extra cushion and also helps with the socialized aspect of the overall program. So even though you may charge individual departments, you're still going to need some socialized aspect to handle those claims that are really unusual. That's your $1 million claim, and depending on what your SI or when it kicks in, the organization as a whole may have to pay for those type of claims. The other types of costs, which are more straightforward, insurance premiums, again, can be allocated to one department if that department has only exposure, or premiums that can cover all departments and you allocate evenly. So what would be coverage that you may only do one department? Well, I think Berkeley has a ship and a submarine, I think, or something like that. So you have a marine risk. So you'll have an insurance policy for that most likely. UC Davis for us also has an airport, so you have aviation risk. Well, should San Diego and UCLA pay for the insurance premium for something that they don't have? Probably not. So that's where you would allocate specifically those insurance premiums to those specific programs, more likely. We talked about cost of risk control techniques. Typical long-term capital investments can be allocated to a particular department. So what would be a risk control technique, maybe for property? Well, how about it could be earthquake bracing. It could be sprinklers being installed. So maybe you're going to allocate some particular so the risk control costs. So the capital investments is you're going to charge that department for installation, but they're going to ultimately benefit from it in the long term. But in the beginning, that's how you're going to allocate kind of those capital expenditures over a longer period of time. And if a risk control expenditure cannot be allocated to a particular department, it's going to be usually treated as overhead. So the idea being that in some cases, if we're going to do just capital improvements in general, or deferred maintenance in some cases might be considered more of the overhead, and so it's not necessarily going to be allocated specifically to a department. And then lastly, cost of administering risk management activities, which would be operating budget of the risk management department. So as I mentioned before, like my time and our staff that are within Office of Risk Services or any self-insured organization, they're going to have to pay for the staff that are working there to manage the self-insured program. And so those are the costs that will be part of that can be allocated out as well as a means to fund that department. So now moving on to the approaches to cost allocation. So now we've kind of talked into the reasons why we want to do it. What are the benefits to it? Whether we want to do risk sharing, risk bearing, what kind of things we can do. Now we want to say, okay, now that we decide we're going to do it, how are we going to allocate those costs? And there's really two ways. There's the prospective and a retrospective approach. So the prospective approach is it's an allocation approach in which estimated costs are allocated at the beginning of the accounting period, so beginning of a fiscal year, that is what that means, in which they're expected to be incurred. So it's a very simple way. Actuary says you need to collect this much money, or here's the total insurance costs and how much you're going to be charging, and then you basically you're going to allocate those to those prospective departments and say, and this is basically what UC does in most organizations. We know we need to collect, let's say, $90 million for this next year for our work comp program. Based upon payroll from each of the campuses, we just allocate that and we charge each of those campuses those costs, and that's how the program is funded, based upon those operating units. At the campus level, if they wanted to, they could do a claim cost allocation to their departments if they chose to do it. So that's basically the prospective. Advantages, it's a more stable budget. What I mean by budget is that from this, going forward, I know this is our cost, and the departments know what their budgets are. They plan for that, and then we collect the dollars, and we're basically they're done as part of that. The disadvantages of it, and the biggest one, is actual costs can differ substantially from what was allocated. So if we say, a department or a store or a campus that we expect $1 million in losses, that's what we charge them for the insurance, and they had a $5 million in losses. Well, what are you going to do? That's their budget. You're not going to, what most likely is going to happen is that it's going to catch up with them the next year, based upon the socialization of it, or the other campuses based upon what they paid in, because it is socialized that another campus that we collected $2 million from had 0 losses. And so that's going to help pay for those losses from the other locations. So that's the idea behind that. So the disadvantages are, first one, you may not collect the appropriate amount of money, and they're going to differ. And sometimes you may collect too much from one and not enough from another. And then also the concern is that risk control activity, or the results, can be separated by several accounting periods. So, and we talked about delay the positive influence of cost allocation. That if we've implemented a safety program, a slip-resistant shoe program or something, well, sometimes it may take, another year before we see the results of certain type of interventions. And so the return on investment may not be, readily there, but by doing some of the allocation. So, and where this comes into, why this is important is that if we're going to charge for, like, say, sprinklers, well, there's a huge investment in doing that, but we're not really, where I'm going with this, you're not going to see the return on investment from the allocation of what we budgeted for that, what we charged that particular location to do that particular risk control activity. On a retrospective, it's actually, we start at the same point. We estimate costs are allocated at the beginning of accounting period during which they're expected to be incurred, but, and this is where it changes, but incurred, but can then be reallocated one or more times during or after the close of the period, with payments or returns made retrospectively according to changes in loss experience. And so I'll use the Rayleigh's example here, is that basically they would do the initial allocation, but then each period actually they would get a report. So they had 13 reporting periods in a year, and they would get this report back, and it would say, what their work comp costs or general liability program costs were, and at some point, if they were if they showed that their costs were exceeding what their budget allocation was, then basically those additional dollars were taken from the bottom line. So the profitability was impacted from that. They would have to make a payment, or they're assessed essentially to do that. On the flip side, if they did really good at the end of the reporting period in the fiscal year, those monies that were allocated would then be returned back to the individual location. It would basically be an addition to their bottom line, and could be considered profit at that point because they did a better job. The advantages of doing a system like that, they're more actively attributed to the accounting period and the department. The department gets rewarded for having a good program. I would say it's probably more fair. It's more responsive to risk control activity. So if we implement let's say, a slip resistant or shoes for crews type program, and we start seeing less losses, well, we're going to get directly the impact of having less claims. And so that's a direct benefit. It encourages risk control. So you can kind of see where we tie back into those principles, encourage risk control, encourages risk retention, reduce costs. Now you can kind of see the advantages of some of that. The disadvantages, ultimate cost to departments are usually not known until end of accounting period. Okay, what that means is that if we have a claim at the beginning, there's that loss development. We know a claim that's $10,000 may cost more, and depending on if you have a 1-year allocation or a 3-year, like Rayleigh's did, the ultimate costs are going to be done over a longer period of time. And I would say that it can be, it is more complicated to manage. In most cases, if you're a large organization, it's going to be fairly complicated. You're going to have really an internal risk management information system that's going to be tied into your budget, your budget documents or your accounting department documents, so that you make sure that every month that you're getting this information, it trues up. So because the challenge is your third-party information, your loss run information, needs to be sent to your accounting department so that it gets reflected on the location's P&L or their budget documents, if it's a public organization, things like that. So once you've decided, you said, okay, we're going to do either prospective or retrospective. Now we need to, now how are we going to base our claim cost allocation system? So there's typically a couple different ways you can do it, which are you're going to either use an exposure-based system or an experience-based system. So an exposure-based system is where you're going to allocate the cost to departments on the basis of their exposures, regardless of loss experience. So when we talk about exposures, it's the number of FTE, number of hours worked, the payroll, square footage, sales, but it's going to be some exposure-based system. And so it doesn't really matter how many claims they've had in the past or anything. That's how you can do it. Now, typically, for workers' comp, most likely, most locations, they're going to do it on payroll. That's the actuary looks at the total payroll, and they say this is how much you're going to charge. And so then we, in turn, allocate on a proportional basis to our campuses that exposure base. And that's what they're going to be charged on that prospective rating system, or that prospective cost allocation is going to be based on that. Now, then there's also an experience-based system, which you're going to allocate cost departments according to the pro rata portion of past losses. So in many ways, I think we've used the term experience modification factor, or XMOD. That's what an experience-based system is. It's essentially saying that this, organizations or department or campus losses are higher, and so their rate is going to be, let's say, experience mod of 1.2, which basically means they're going to, if average is 1, they're going to pay 20% more than what the average campus or average rate would be. So now most organizations use a blended approach, and that's exactly what we do as well. Is that you're going to basically say, here's what the total payroll is, so we know how we're going to allocate the cost. But we're also going to say, it may be 80-20 or 75-25. It's going to be on the exposure base and probably smaller percentage on the experience. And so they're going to take a little ding on the experience base, or they can have a benefit if they are. We have some campuses that are, experience mods 0.6. Now that's our internal modification factor, and so they're going to basically pay about 40% less than any other campus on because of their rate. And so Managers of larger organizations prefer more emphasis on experience because they can control or impact their loss experience. Okay, and that's the key bullet there, is that the more emphasis on experience, that means that if I'm a poor player or not a poor performer as a manager or organization, and the only way I'm going to get my rates lower is by having a better experience. My exposure base is going to always stay the same, but if I do a better job in preventing claims, it's going to encourage that type of behavior, which goes back to having an appropriate, what the principles are and having an effective system. So on an exposure-based system, here's a couple examples of how you might do an exposure-based. For general liability, it's probably going to be square footage, sales, payroll, annual budget. Actually, if I remember correctly, there will be a question most likely on this of if you're going to do a, what would be an appropriate exposure base for this type of exposure. And so you do want to know what would be most appropriate. So general liability, you're looking at square footage, sales, payroll, annual budget will be part of that. Auto liability, typically it's going to be the number of vehicles or miles driven. Workers' comp would be payroll, full-time equivalents, or job classification. Job classification being what I mentioned before of number of, administrative versus law enforcement, things like that might be a basis. On property, typically it's square footage or property values. And then other exposures would be activities with risk management related to other exposures, so crime, fidelity. It just kind of depends on how those are going to be allocated, though. But typically, there's going to be some type of question that's going to say what would be the type of exposure you'd want to use as a potential to do a claim cost allocation. On an experience-based system, as I mentioned before, it's often an indicator of the success of a risk management program is measured by frequency or aggregate severity limited to some dollar amount. And so an actuary, they'll take a look at the claims, and this is where the actuary does come in. They'll help create an experience mod factor, or an insurance carrier will create an experience mod factor. And it's going to be, when we talk about aggregate severity, it's limited to a dollar amount. They're going to cap the severity on these claims, and they might do 250,000 or 100,000, because the point here is more the frequency is what they're looking at. It's how frequently these claims occur, and if they're always in the if there's a frequent but there's a lot of really small claims, that's one thing. But if the frequent and the aggregate severity even capped is really high, your experience modifications also is going to be quite high as well. So frequency is typically a better indicator. Because it's one thing you can control. You can hopefully prevent someone from slipping and falling by having a slip-resistant shoe program or other things. But once a claim occurs, your tools in your toolbox to limit the cost of the claim is fairly limited, because now you're into post-injury management, return to work, and those type of things. The aggregate severity, in this case, would be the cumulative losses for a given period, and each loss charge department is limited to a certain amount, such as I mentioned, like $25 per occurrence. Some of the considerations in calculating aggregate severity is per occurrence per limit, which makes management focus on frequency. And so again, this is where the actuaries would come in. So if you said, per 25,000 or up to 50,000, but the goal is you want to make them focus on the frequency. The aggregate limit will be another factor, and then finally the experience period of how long are you looking at when you're going to be doing your experience system. When people use XMODs, it's usually using the last 3 years of data, or last 4 years, including the most recent. It's kind of the same thing on how the actuaries look at the projections. There are some organizations, because of the limited amount of data to have a good history, that they go back 15 years worth of experience. You can base your experience calculations on anything you want. It's up to the organization to decide, and these are part of the considerations that you want to look at. So that's why this is, it talks about considerations. Just because the normal XMOD is what the insurance uses doesn't mean you have to use the same type of experience. You can do something totally different as long as your organization feels comfortable of what, of the soundness of that experience-based system. So now moving to some of the practical considerations, and then we'll have fun with some of the charts here, is the when you look, if you're going to do a claim, a cost allocation, some of the considerations are your accounting system. If you have to have a good accounting system that would be able to handle this and have a relationship, if nothing else, with your accounting department to make sure that they can do a claim cost allocation. So especially if you're doing a retrospective type one. The tax system for the organization's operations can also be impacted. And when we talk about tax system, it's kind of more the profitability. It's some of those aspects that are discussed in there. A minimum charge amounts for risk management services, that by doing this, you're going to have to determine what's a fair price of the services that the risk management department or safety services are providing. Determination of cost allocation is insignificant. So what that's kind of going to on there is there's kind of two things that go in mind is how small of a claim, do you want to worry about doing a claim cost allocation? Are you large enough to make sense? Because it may cost you more to do claim cost allocation than what it's worth is kind of where that's going. Penalties or rewards for department managers need to be some of the considerations. Inclusion of managers in development of the system. The need for a risk management information system. A lot of times, in order to do this, especially again from a retrospective, you'll need to have that. And then also consideration of changes in the organization structure. That if things are going to change, where departments change names or you have different people in charge, these are all things that can impact your claim cost allocation system. So the main thing from a test standpoint, exam standpoint, that I would focus on in here is just know, you don't need to know a lot of detail of what each one of these items are, but to just know what are some of the considerations that you need to consider as part of this. And typically, I would say if you're going to have the question, it's going to be looking at the accounting system, then the risk management information system, and changes in organizational structure are probably the big kind of things that you'll probably see on there. And the reason why is because those are probably the biggest impacts, is that if you change your organizational structure, that changes your org structure and your risk management information system, and it can impact your payroll system. It has a lot of downstream effects, and so it's something that has to be part of it. And really the need for risk management information system that can do some of the reporting that's necessary, that can tie into the accounting system, is really going to be key to really have an effective, as we talked about at the beginning, a claim cost allocation system. There can be some that are simpler, but that's just one of the things you need to keep in mind. Now to the charts. So the last part of the chapter dealt with kind of giving a case study and what would you do, and you'll see the information on the side here that that really talks about the how to do an allocation. And I'm not going to go through each all the different details in here, but that talks about. But I know that some people can get confused as what these charts are really trying to tell you, and again, to be able to explain it. Most likely you'll have some type of question that will look at this and say, okay, what is the best method, or what type of system is this? So the first one we're going to talk about is allocation of costs based upon square footage. Okay, so this is an exposure-based. This is our exposure-based method that we're looking at, what are we going to charge for this? And so if you look, and what you want to get out of this is how, by using different methods, how completely out of whack what you might charge a different department these units, operating units. And so why a blended model would most likely be better based upon this. So if we have these type of things, we have a hotel, apartment building, another hotel, office building, and another hotel. So our total square footage is 1 million square feet. And you can see that each one of these is about 200,000, 300,000. So our percentage off a million, that's pretty easy to calculate. Okay, that's there. Now, where people try to get and they go, well, how did they get the $60,000? Where'd that come from? Well, what they determined in here is there's the $300,000 that they're going to retain, the cost allocation. That is what they expect the losses to be, and that's actually in here somewhere. But But the idea is that they're going to be doing 20% times 300,000 is equal to 60, 30% times 300,000 is 90. So that's what they're doing, is they're really allocating based upon the percentage of the square footage of the exposure base to the $300,000 amount. And I think the 300,000 comes from a different area in the textbook there. So that's the exposure-based method. So if we use the exposure-based method, we would say we're going to charge, Los Angeles hotel $60,000 and the apartment building $90,000. Well, one of the things to keep in mind is that, well, a hotel, you get transient occupancy going in and out. You have a lot of people that aren't familiar with the building. You probably have more wear and tear. So you probably have higher costs. With the apartment building, you may have lower because you're hopefully going to have more stable people there. And same thing in an office building, you're probably going to even have less because it's more, the type of operations that are occurring in there. Again, a hotel, you might have people smoking. Well, I guess apartment building you could too, but you can have more damage caused because of people not caring as much. Now, what this is doing is saying allocation of retained claims by 3 years, cumulative claim experience capped at $10,000 per occurrence. So the idea behind this chart on here is it's saying that over the last 3 years of claims, we've had 75,000, 75,000, and the most recent year was 40,000. So the total claims cost that we've had is 190,000 in the hotel. The apartment building, you can see here, they've had lower claims each of the years, so they only had 70,000, and you can kind of, again, get the percentages. So the total claims that they've had was about $400,000. So if you take a look at the total claims, 47.5 or 190,000 of 400,000, that's where this 47.5 comes from. Okay, at the 30,000 out of this is 7.5, and again, you can kind of see where some of these numbers are now coming from. So actually, I take that back. I messed up on that, what I just explained there. The 47.5 is actually going to be the smaller portion. That's what we're going to add down here. Excuse me. So you can see but the total claims amount here, and then the percentage, so the cost allocation in this case is going to be column 7 times the 150, okay? And so what we can see down here is the column 7, so it's 47.5% times 150 is the 71,000. So this is how much they would be charged under this model. Now remember where the 400,000 came from. Is the $400,000 the total claims cost, and what they're going to say in here is that they're going to retain the first 150. So, and that's where the 250 comes from. So that's, but they're looking at the experience over the last 3 years. How much should we consider to retain as part of that? Now what they're doing is saying, well, let's allocate of insurance premium. So before, this is the claims we've actually had. Now what they're looking at is, well, let's allocate the insurance premium. So this is a different aspect now. Now we're talking about insurance premium. So on here now, we say, okay, the square footage, which we had before, and the rate. This is the rate, that they came up with. It's not, part of the calculations necessarily. And they say, okay, let's take column 3 times column 4. So 200,000 times the rate, and we come up with $45,000, and that's based upon, and we come up with our insurance premium of $150,000, right? Or or the adjusted square footage on here. It's going to be the 150. Now we take the percentage again, and we do the same thing. 30% times 250, we come up with 75,000. 20 times 250 is 50, and we come up. So this is the allocation of the insurance premium. So based upon the adjusted square footage, based upon kind of the risk here, we now say that, well, this place should be paying, 75,000, and the apartment buildings can be 50,000 of that total amount that they're going to be charged for that insurance premium. Now we go down to the next one. So now we're going to allocation of insurance premium based on 5 years of claims experience between 10,000 and 50,000 per occurrence. So now we look at it and we say, okay, the first year, and this is 5 years worth, and they're just kind of going through the different machinations of this, and so that's why and to come down when we go to the final chart, you'll see where this kind of ends up of where we started and where we ended up with. So the first year, or at least recent year, we didn't have any losses. And then we had, total, you can see the cumulative effect. Again, in this case, we still have $400,000 worth of losses over that 5-year time period. Okay? And as a percentage, we do, percentage of total, what these things are, and then 20% times the 250, and we come up with the 50,000, 45. And so now you look at it and you go, wow, okay, the allocation of insurance premium is 112,500 under this model. So now we have, you can kind of see where things can really fluctuate depending on whether you're using exposure-based, and now this is experience-based. And you can see the experience-based shows the hotel should be charged more money, whereas if you looked at the exposure-based, it was saying the apartment building should be charged the most money. And so finally, we're almost to the last couple charts here. Is now we're going to look at an allocation of insurance premium based on experience and exposure. So what this is doing is it's now saying that we're going to base 80% on the exposure. So you see the 80% there, and you can see the 20% here based upon experience. So what we're basically doing now is our exposure percentage is, you can see these 30, 20 down here, and then the exposure percentage is 80% of column 3. So now I'm taking 80% times our 30% exposure, 80% times our 20% equals 16, and now we come up with our 80% exposure there. Our experience percentage that we came up with on the previous chart, so let's say 45, where's that one at? Where's our experience one there? It's right here, 45, 20, 30, right? So now we have that, and now we multiply 20% times each one of these. Now what we do is we do column 4, 24 plus 9 is 33%. And what this is saying now, based upon this model of exposure plus experience model, is that if you were to add these things, and so we get 33% times the 250, and we come up with 82,500, and then 20% times 250 is 50,000. So this becomes what our allocation of the insurance premium based on experience and exposure. And so what they basically are doing here is they want to show how this was different from what the impact of exposure, using exposure versus experience is what they're trying to show here. So the final premium allocation was 82,500. The final retained claim allocation was a 71,250. So this is our 250. So if we go back to the original chart, this is what our premium is, 250. Our retained claim allocation is 150. And if we do the final total, which is 3 plus 4, and what our initial claim is, you can kind of see our final total cost allocation is 153,000 for the hotel, and it's 76,000 for the apartment building and 106 for the hotel. You kind of go through the office buildings, only 9,000. But you can see the difference here is that the initial cost allocation was, we're going to say 60,000 based upon just the exposure. And you can see that's 156% higher when you include their actual experience in this, and what a difference it makes for the office building, because their exposure really is fairly limited. Their buildings, originally was 30,000, but really the final cost, because they haven't had very high experience, is only going to be 9,700 or 9,750 instead of 30,000. And we still come up with the same dollar amount of the total claim cost allocation, or the 400,000 that we're going to spend, the 250 plus 150. Or 400. So, as far as spending a lot of time on this, I probably, wouldn't, spend a whole lot of time, other than the main thing is to understand how experience and exposure can impact your claim cost allocation system. That's really what this is trying to demonstrate, is that depending on your methodology of how you set up, if you do 75-25, it can make a huge difference in how you do a claim cost allocation program as part of it. So David, your hand's up. I'm going to go and unmute your line here. So David, you're unmuted. Go ahead.
Good evening. I just wanted to know, on the national exam, what's the likelihood we're going to get asked questions trying to figure out all these different issues that you're talking about?
Very small.
Okay.
So actually there's a little feedback there. I'm going to go and mute you back up here. So as far as the likelihood of getting an exam, what they really want you to understand is the impact of exposure that, and just to be able to, if you have a chart, what they're going to say is, what does this mean? You're not going to have to do the calculations, because if we go back to what the objectives are for this particular section, the objectives for this are going to be, at least the last one, is given a case study, justify how hazard risk management costs may be allocated among the organization's departments. So you need to justify, and so what the justification really is going to be is it experience-based or exposure-based? And you can see that even a 20% exposure base, if you did 100% exposure based, oh my gosh, the costs are going to be extremely high, that there would be no insurance coverage. Denver would not, office building would have to pay anything. Whereas with the, 80% 20 mix, actually does a pretty good job of kind of making it more distribute fairly, kind of going back to those key concepts of, if you look at these things, is it fair? Does it charge costs specifically to those units in which they had? And that'll be part of it. So you're not going to have to do the calculations other than justify how hazard. If it said calculate, then I'd say yes. You're not going to have to calculate on this one. Also, the exercises and the attachments or the Q&A, I think will also help with this. That's kind of the example. You're going to want to make sure that you're kind of thinking through actually how to do some of that aspect of it. So if there's any other questions, we actually went through fairly quick tonight. So feel free to ask other questions, certainly email. And we will be doing the other class here on the following night. So look forward to everyone's participation. In the meantime, feel free to email me offline if needed, and we'll feel free to cover that information.